Wall Street, financial news, money managers, and retirement planners all tout some form of buy and hold as the best method for investing. In some sense, it's the consensus of the experts that investing little amounts consistently into the market and leaving that money there is the best secret to big returns. I'm a contrarian, and I disagree. I've got 4 primary reasons. First, lack of control. If I stick my money in the market and leave it there, I have to take what the market gives me, good or bad, profits or losses. They claim that leaving your money with them and letting the market do its thing works over the long term. But in reality, people experience a lot of stress and anguish when their 401k gets cut into a 201k in short order. It happened back in 2001, again in 2008, and a third time in 2020. The reasons don't matter so much as the experience. If you don't take control, you're along for the ride. And if your retirement date winds you up in one of the troughs, your golden years might look more like bronze years. Second is lackluster returns. Repeated roller coaster plunges aside, the experts tout investing for the long term as the solution. If you look at long-term averages, the S&P returns about 10% per year from 1965 to 2020, as calculated by Berkshire Hathaway. That includes dividends reinvested, and that number holds up over the long term, although a given 10 or 20-year period can vary dramatically. For instance, for the 20 years ending December 31, 2019, the average was only 6.06%. It must be said that almost nobody in the professional money management space even matches those returns regularly because they don't plan for it. None of the pros at the brokerage houses recommend putting your money 100% into a benchmark like the S&P 500 ETF. So the benchmark returns they often tout don't line up with the reality of how anybody invests. It's just a measuring stick. In reality, the average money manager plans for returns as low as 6.6% nearing retirement, according to the Motley Fool. And the average retail investor does as little as 4.25% per year, according to research from Dalbar Inc. Throw in inflation, taxes, account fees, and you're sitting on the slow boat to wealth generation. I don't have 100 years to compound gains. I want more now. My third reason for being a contrarian is one-size-fits-all results. Using a benchmark as the assumption for calculating returns and retirement growth leads to poor predictive results. As mentioned above, if your retirement year lands in a trough or a downturn, your nest egg isn't going to provide nearly as much retirement income as you hoped for. There are ways to counter that, but the buy and hold crowd claims there's too much risk to do so. If you are lucky enough to retire during a market peak and remove all your funds from the market, your retirement manager looks like a genius. Personally, I don't want my investments to have that much chance involved when a little attention and effort on my part can earn me consistent growth even after I retire. And my fourth reason is the roller coaster experiences. I don't know about you, but I don't like losing. I especially don't like that gut-churning feeling of opening my accounts to discover that my money has dwindled away with a market drop, while I sat by and did nothing. A couple of easy risk management practices can get rid of most roller coaster experiences, meaning your losses become smaller and your gains grow. Now that we've covered the problems with the conventional model, let's turn our attention to the typical advice on actively trading that we see in most books and courses. If you've spent any time at all learning to trade, you recognize how quickly this turns into a complicated endeavor.